Hello and welcome to my channel. My name's Charles Dynastic. I'm the Managing Director of Blue Bond Tax Planning. I've been a specialist inheritance tax planner for more than 18 years now and have helped hundreds of clients avoid their inheritance tax. Now this video is quite specialist because it's aimed at professional landlords, people who own multiple properties. You will already know that your accountants are recommending that you hold your properties in a limited company rather than holding them personally. So why is that? It's because of the implications of something called Section 24. Now that basically says that you get a 20% credit against mortgage interest as opposed to in the past being able to totally offset it against the profits in your rental portfolio. Now, because of that implication, as I say, most high street accountants are saying set up limited companies. However, this video talks about why I believe they're wrong and what you can do about it. If you're a landlord that actually has no mortgages, you're not implicated by Section 24. However, you should still watch this video because there's a lot of other major benefits that come out of the result of the strategy that I'm recommending. So why are most accountants wrong to recommend simple limited companies? Well, the vast majority of high street accountants are not tax planners and therefore they don't fully understand family investment companies. It's a very specialist line of work. Now, they are correct about the income tax benefits, but they've not thought through the long-term inheritance tax implications. Now, all professional landlords with property portfolios which are valued at over $1 million or are going to grow to over $1 million will have a significant inheritance tax problem, and most landlords want to pass their properties on to their families free of inheritance tax. So how do you do with this? So if you gift property to your children during your lifetime, it's a potentially exempt transfer. You live 7 years. Yeah, it's outside of your estate for inheritance tax, but it's a disposal for capital gains tax purposes. And that means the capital gains tax is payable immediately. Although you've got allowances of $12,300 at point of speaking, many of the landlords I deal with have got capital gains tax issues of more than $1 million. So really gifting the property doesn't make any sense to them. Also, if you gift the properties to your children, it means that you can't get an income stream because you don't own the property. You've gifted it away. And if you get an income stream, that's called a gift with reservation of benefit, and therefore it would fail for inheritance tax purposes. Now, another issue is that the children may be higher rate taxpayers already or close to higher rate taxpayers, and therefore giving them the income stream would mean that the income is now subject to higher rate tax, which also isn't very efficient. So what else could you do? So accountants are saying, and accountants who don't know what they're doing are saying, well, if you put the money into a limited company, you also generate the capital gains tax. Just put a little bit in every year and maybe that solves the problem. No, there's an alternative strategy. Now, first of all, which I'll explain as we go on, but if you don't understand what a family investment company is, please watch my previous video, which is entitled Why You Should Use a Family Investment Company to Avoid Inheritance Tax on Large Estates. Now, when you set up a family investment company, it'll cost about £5,000 or more compared to just £400 for a limited company. But once the tax rules are set up, a family investment company, the same tax rules apply as to a normal limited company, at least for the time being. Now, how do you get around the CGT? So what you do first of all is you set up a partnership. So let's say it's husband and wife, they own the properties 50-50. Strictly speaking, they should be getting the income 50-50. But if one's got a big pension and the other one hasn't, then or their income streams are different, that's not always the most sensible thing. Now, by setting up the partnership and a registered partnership, sure, you're going to have to pay the accountant to do the tax return. However, it can have a tax saving because you can vary the income. So one partner could take 90% of the income and the other one could take 10 without changing the ownership of the properties at all. When you set up the partnership, there is no disposal of the asset. You still own the properties. So there's no capital gains tax and there's no stamp duty land tax. Right, now while you've got the properties in a partnership, you're going to have to hold that partnership for around 3 years, because basically what you're then going to do is you're going to convert it into a family investment company. So you're converting from one type of business to another, and this is well trodden ground for lots of different types of businesses that have got nothing to do with property, converting from partnerships to limited companies. So when you convert, you can claim incorporation relief. And at that point, there is also no capital gains tax to pay or stamp duty land tax to pay on the setup of a family investment company. But it is built into the company, which I'll explain in just a minute. Now, a normal off-the-shelf limited company only costs around £400 because 95% of companies in the UK, probably 99%, have standard articles of association, right? The rules of the company are exactly the same, which is why it's so cheap to set up. However, when you set up a family investment company, what you're doing is you're changing the articles of association. And therefore you need specialist lawyers together with experienced tax accountants who know how to do this kind of work, and they set up a bespoke company with bespoke articles of association. Now, how complex you choose to make the rules of that company will have an impact on the cost of setup. So anything from 5,000 to 15,000, and I know some companies are even charging 25,000. Okay, so a wide variance in costs. But the long-term income tax implications and savings and the inheritance tax savings will make the setup of a family investment company well worth it for the vast majority of professional landlords. So what happens when you set up a family investment company? Well, the share value is the original purchase price of the properties on the day that you set up the company. The day after, the share value is now the current value of the properties if you dispose of the shares by giving them away or by effectively selling them. Right. So what you've done is you've swapped corporation tax instead of capital gains tax. But actually the rates on corporation tax are generally lower than capital gains tax. Now, the other thing you can do is you can and you should set up alphabet shares. So I'll explain that in just a second. Now, very simply, the capital shares are exchanged for the properties, so therefore there is no exchange of value, so there is no capital gains tax to pay, and there is no stamp duty lands tax to pay. Now, what some clients do is that you can drip feed your properties into the company, and when you give the properties over, you can, of course, set up directors' loans as well. And by doing it every year, you can effectively create directors' loans on an ongoing basis. But bear in mind that the longer you delay, the more the properties are in your estate. So if you're older, probably that's not a sensible strategy. But you can create directors' loans if you choose. Another thing you should do is you should definitely, when you're setting up the company, set up something called an entrenched directorship. Now, this basically says is it doesn't matter who owns the capital shares of the company, because eventually you're going to give those shares away. Because if you retain those capital shares, you're going to be liable for inheritance tax because it's an investment company. So you're eventually going to have to give those shares away using your capital gains tax allowances over a number of years. And once you've given the shares away, then you're not entitled to any income unless you've got an entrenched directorship, which means you can get an income purely and simply because you're a director of the company. Now, that is limited to some degree depending upon how much work you're doing. So if you're 85 and doing absolutely nothing in the company, then obviously the income stream that you can take out is going to be reduced. So another thing you do is, as I said, you set up alphabet shares. So if we're saying the parents, they get A and B shares, the children get B, C, D, E shares, the grandchildren F, G, H shares, providing they're adult grandchildren. And basically then those children and grandchildren, you're giving them growth shares only. They're not getting capital shares. So the difference is there's no transfer of value, and therefore all the growth in the company and the growth in the value of the properties from there on is capped in the parents' names, but then the future growth is then in the children's or grandchildren's name, depending upon how you want to do it. So it stops the IHT problem getting any worse. But also by having the alphabet shares, it means you can allocate different dividends to different people, thus controlling the income stream and the income tax that's then payable. Another major benefit is that because the rules of the company say that only bloodline, children and grandchildren and great-grandchildren can own shares, in a divorce court, what's the value of the shares? Well, nobody else is allowed to own shares unless you're a family member. So spouses of your children are not allowed to own shares, right? So in a divorce, they can't have the shares. Can they have the value? Well, what's the value? Well, as long as you're alive, you're the director and not the children. So there's no income stream coming to those dividends unless you say so. So that keeps the value down. Nobody else can have shares, so that keeps the value down. Some people would actually say the value is zero. But certainly a divorce court might not agree, but it certainly wouldn't be the true underlying value of the properties because they don't have control and nobody else can own the shares. That's the point. So the values are reduced in a divorce court. Now, another major benefit of a company, and this is the same for any company, irrelevant of it being a family investment company, is that you can make pension contributions for your children. So let's say your property portfolio makes £80,000 a year and you've got two children. Well, if you pay £40,000 a year into each of those two children's pensions, that means the company has actually made no profit at all, therefore there's no tax, and you've extracted all that income from the rental without paying any tax on it because it's gone straight into your children's pensions. So that's a possibility. As I said, directors' loans can be created, but you need to be careful of not going over your CGT allowances as you put the properties in. But if directors' loans are quite big because you started this really young, by the time you're older, say 75, 78, you should give up those directors' loans to your children, and that's a potentially exempt transfer for inheritance tax purposes, so the 7-year rules apply. You can also, if you choose, give away capital shares to your children using your annual CGT allowances. Many of our clients have large property portfolios, and therefore the capital gains tax is significant, sometimes well over $1 million, and therefore you can't use just your CGT allowances to get rid of the problem. So there is something called an employee benefit trust which can be set up, and it's an employee benefit trust, therefore the children and adult grandchildren are employees, therefore you give the capital shares away into that trust and for the benefit of those employees, and that is immediately free of inheritance tax as well. So that's how you get rid of the capital gains tax, or at least defer it for years and years and years, and tax deferred is tax saved. Now, fairly obviously, this is complex planning and therefore you require specialist tax accountants and lawyers. Do not rely on your existing high street accountants. They simply don't have the expertise for this. Now, Blue Bond does have strong relationships with a number of firms that set up family investment companies, and with our conversations with you, depending upon the complexities, we will introduce you to the firm that we think is best to suit you. Another major benefit of dealing with us is that obviously it's complex, you're going to have a lot of questions, and if we're explaining the answers to you, you're not paying a tax accountant £300 an hour, and we do it on a fixed fee basis anyway. So yeah, it saves you quite a lot of money when we're explaining it to you. Another major benefit, there is no limit to the size of property portfolio you can put into a family investment company. You could go up to 100 million, frankly. There is no limit, and it works for everybody. So major benefit, and therefore well worth considering if you're a professional landlord. So what are the main benefits of the family investment company versus a normal limited company? And this is why I'm saying that accountants are short-sighted in what they're doing. So first of all, entrenched directorship is possible within a family investment company. In other words, it says, doesn't matter who owns the shares, I'm a director for life. That's it, I set up the company, and therefore you can have an income stream for life. You can't do that in a normal limited company. You can set up alphabet shares. HMRC frown on alphabet shares within normal companies because otherwise people could give all of their employees different share classes and save lots of income tax. But because the company is closed, only children, grandchildren are allowed to own shares. Alphabet shares are fine in this particular regime. It obviously retains control of the company within the family bloodline. Nobody else is allowed to own shares, remember. It reduces the value of those shares in a divorce hearing, and bear in mind the company could be lasting years and years, and it's not just your children, it could be your grandchildren as well. So long-term benefit of retaining control, and really the tax benefits are enormous. So you could end up paying no inheritance tax, no capital gains tax, no stamp duty, land tax, and you'd probably save a fortune on income tax as well. So what's not to like about family investment companies? Okay, so it's not a silver bullet. Now, as explained in my previous video, you shouldn't rely 100% on family investment companies to deal with your inheritance tax problem. Why? Because Section 24 has already shown us that HMRC, together with the government, are willing to put specific tax rules in for landlords. Okay. So if they've done it for people who own property personally, what's to stop them doing it for companies that own mainly rental properties? The answer is nothing. And therefore, what could they do? Change the corporation tax rates maybe? Okay, problem. Make it an issue as far as inheritance tax is concerned? Maybe. All of those things may have to be dealt with, but if you've got a large property portfolio, at the moment this works, and therefore it's a sensible strategy to utilize it. But while you're utilizing it, you should also be putting investments into trust. Because if you gift all of your shares, your capital shares away, you can only get a limited amount of money as solely as a director. But also you need capital behind you in your old age if something goes wrong medically. Worst case, you go into care. So for most of our clients, we're saying, okay, place the maximum you can into a trust. 15 years later, if you put 325,000 in, potentially it could be worth 650,000. 15, 20 years later, it may be worth $1 million. You've got more than enough money to get back, should you need it, to then pay for care home fees, or if something goes medically wrong, you need some sort of an operation or something. All older people do absolutely need capital behind them, but if you retain capital, you're going to be liable to inheritance tax. So it's a balance of family investment companies and trusts. Okay. Really, you need experienced advice for an integrated plan, because what we're talking about is structures for estate planning on your death. We're talking about family investment companies, life insurance, gifts into trust during your lifetime, maybe gifts to your children, maybe pension plans around what your children choose. So lots of different things need to come together. And really, you need experienced advice across all of those areas for a plan that works. So if you visit our website, you can book a free personal meeting to discuss all of this and to see how we can help you. And I look forward to talking to you at that time. If you found this video useful, please give us a like and subscribe. And I look forward to seeing you in the next video. Thanks, and bye for now.